and of course, by myself. All right. Good evening, everyone, and welcome to the DC3 Business Class. We are just giving everyone a few more minutes to join in. If you can, if you would like, we wish if you could go ahead and just share this out on Facebook, as well as if you're watching on YouTube, also share it to your friends as well. We will be getting started here in about 3 minutes.
Well, I have 6:30. Dan, are you ready to get started?
Yep, we can go ahead and get started.
Okay. All right. Well, good evening, everyone, and welcome to the DC3 Business Class. We are just giving everyone a few more minutes to join in. We will be getting started here in about 3 minutes.
Okay.
Thank you. So good evening. Welcome to the DC3 Small Business Class. This is our second installment. I will start sharing my screen. And so there are 4 sessions. The first one, we discussed how to start a business, where to get your name registered with the state or with the county. And then we talked a little bit about, IRS, getting your tax ID number. And then now we're going to talk about financial statements and loans. And so the financial statements are important because when you want to get a loan, or even when you're trying to buy insurance, they want to know how much money you make, how much revenue you make, what your what your employee cost is. Do you have employees or do you have contract workers? And so financial statements are also important when you want to go and get a loan, or if you want to get a grant. So during COVID, when they were asking to see for money, they would ask for your financial statements to see how much money you made, how much you paid your employees. And so they're really important. The first one we're going to talk about tonight is profit and loss statement. It shows the company's revenues and expenses during a particular period. It indicates how the revenues are transformed into net income or net profit. And then also you can do this, you can update it monthly, quarterly, yearly, or year to date. I would suggest you would do it monthly. You can use anything from Excel when you're a small business, like if you're not making a whole bunch of money, or you can invest in QuickBooks online or the desktop version, which is usually about $200 to $300, depending on what you need it for. And then if you want to do the online, you can get it at maybe $50 a month. You can do that, or you can hire an accountant or a bookkeeper. When you're first starting out, you kind of want to know how your business is doing, and you can pay for QuickBooks, or you can put on an Excel spreadsheet, but you kind of need to know the ins and outs, and then you can hire a bookkeeper or accountant. But if you are starting to make a lot of money on your contracts, you need someone to keep track of it while you're going out collecting the money and then doing business development. You can hire a bookkeeper or contractor on like a monthly fee. It doesn't have to be a full-time employee, because that's an extra cost for you that you have to pay for taxes. The next statement is a balance sheet. And the balance sheet is just a financial statement that represents the company's assets, liabilities, shareholders' equity. And shareholders' equity means how much you put into the business. And so the balance sheet is just a snapshot representing the state of the company's finances at a certain period of time. And usually we do the balance sheet as the end, as the last day of the month. So it'll always be like January 31st, February 28th, or 29th, depending on leap year, March 31st, always the last day of the month, because that shows that you have some type of accounting acumen. If you do it around the middle part of the month, or like let's say now July 14th, they kind of know that these statements may be faulty, and they may just take a closer look at them, because they know that it wasn't prepared by an accountant or a bookkeeper or CPA. The next statement is a cash flow statement. And you need to do the cash flow statement. It's very important to you, because you need to know how much money you have during the week and how you are going to pay your bills. So it's a financial statement that summarizes the amount of cash and cash equivalents. And cash equivalents would be accounts receivables, prepaid expenses, anything that is very liquidated that you can do. So it measures how well a company manages its cash position, meaning how well the company generates cash to pay its debt obligations and funds its operating expenses. These statements you'll need for a loan, you'll need for the profit and loss, and the balance sheet you'll need for a bond if you ever need to get bonded, and then a profit and loss you'll need for insurance, like at the end of the year, because they want to see how much money you made and how much money you paid your employees or your contractors. So if there are any questions, just let me know, type them in the chat. So this is a fictitious company. It's Mika's Teas, and it's a profit and loss. Usually, you do the profit and loss from maybe January to June, but since the space is limited and we're not in person, I wanted to make it on the screen where you can see what's actually going on. And so, with this business, Mika's Teas, there's T-shirts, polo shirts that we're just going to talk about right now, so it won't get too complicated. And then you have the total revenue. You are a part-time business. You have a full-time job. This is your side hustle that you're trying to get off and running. So the first month you did a community fair where you set up a booth and you sold T-shirts and you made $2,150, and then for May, $3,300, and for June, $2,500. So we'll get to how you break that down in the cost of the T-shirts. I guess let's do that now. The next statement is called a job cost breakdown. And so this is the community fair. And we'll go to this slide so you can see it better. The community fair, you had a blue T-shirt, a red T-shirt, a white T-shirt, a black polo, and a white polo. So you sold 25 of the blue and red T-shirts each. You sold 20 white T-shirts, 20 black polos, 10 black white polos, and then this is the price which you charged. Now you set your own price. I just did an arbitrary number to make it easier doing the calculations. So then the revenue for it is $500 for the blue T-shirt, $500 for the red T-shirt, $400 for the white T-shirt, $500 for the black polo, and for the white polo is $250. That's the revenue. So you sold 100 items for $2,150. For this example, we're going to say it's all cash, and we won't have any credit card fees or anything else like that. So that's your revenue. And then on your job cost breakdown, like when you get into business, you should have a job cost breakdown for each project that you do or each item that you sell. And so the cost per item, the blue T-shirt is $10, the red T-shirt is $10, white T-shirt is $10, the polo is black polo, and the white polo is $15 each. And this is what your manufacturer charges you. All of it together is going to be either $10 or $15. And so in your Excel spreadsheet, what you would do to get the total cost is take the items sold, 25 times 10, and that's $250. And so that is how much it cost you to produce these T-shirts. And so that's $1,150. And so what you would do is that you would take your revenue minus your total cost, and you get your gross revenue. That's $1,000. If we go back to the previous slide, you'll see that's done for like the football team. You sold T-shirts to the football team. In this example, there's 60 football players. You gave them a discounted rate because you knew you could charge the fans. You would buy, the people, their mothers, fathers, friends, high school students, or whoever, the community will buy a lot of T-shirts. And they did. They bought 120 T-shirts. And so that's where you made your money up. Now, you could charge the football team $20. That's up to you. This is just an example. And then going across, it has the same, cost per item, and then what your revenue is. The next one is I put in an ISD contract because let's say you're selling T-shirts, or if you are doing, let's say that you're doing some type of catering. This goes to the same thing. You can do catering at a community fair, and then you can do catering for a football team. You can do the banquet, or you can produce their meals for each game that they have. You could do that. And then for the working for the independent school district, or if you work for the county or the city, they may have lunches that they need you to come in and set up for. And they will give them the menu, and they tell you how many people, and you work out your price with them. And so for this example, you did polos for the speech department, the county department, and maintenance department. And so these are the items you sold for each one, and this is the the price that you charge the school district. And then your revenue, 20 times 25 is 500, 30 times 25 is 750. And then the maintenance department, there were 50 individuals there at $25 a piece. That's $1,250. They chose the same type of polo, just, they put their logo on it. It was the same cost per item. And then here, if you can see it, you did your gross revenue for the item for the school district was $1,000. If we go back to the profit and loss with the 2,500, let's see, here we go. I'm sorry. $2,150, and then $3,300, $2,500. Your total revenue was $7,950. This is what you sold the t-shirts and the polos for. And then your cost of goods sold that you had to produce, this is your costs that you did. And your costs for all three projects were $3,500. So right now, your gross revenue is $4,450 for 3 months. And so the gross revenue means you haven't paid anything from like your advertising or your electricity. This is like a home-based business. So what we, in the example, we're not charging. The rent would be the rent of your apartment or your house, because technically you probably couldn't get a space for $400 a month. But you can, by our IRS tax purposes, you can charge, like the company rent, electricity, utilities, and internet. And so the advertising costs, that you choose what this is just an example, is $75 a month. Whether that's business cards, you chose to advertise on Facebook, or you chose to set up a booth at a community fair, it's $75 a month. That's just, for this purpose, it's a fixed cost. Electricity for your apartment or your home is $50 a month. And then fuel, if you're going out doing business development, it takes gas to do, so $40 a month. Then insurance. Some small businesses do not have insurance, but when you are bidding, let's say with different entities like the county, the airport, and the city, they require that you have insurance. And so the insurance cost for this is $75 each month. And then the internet that you're using to go find your different jobs and turn in bids, $50 a month. Office supplies, maybe you bought a printer, you bought ink or some folders or something, business cards, whatever it is, it's $180. Here's your rent cost, and then your cell phone at $100 a month. So then your total cost for 3 months is $2,550. And then your net revenue for 3 months, well, let's start with April. From the contract you did with the community fair is $260. With the football team was $980. And then with the ISD contract was $660. Now this is before taxes. So when you do your taxes at the end of the year, the accountant or whoever you get to do your taxes, you can do different expenses, depreciation, whatever, to get your tax bill down. But this right here is your net revenue before taxes and before you pay yourself. So, are there any questions about a profit and loss statement? Okay. So the next one would be the balance sheet. And remember, the balance sheet talks about what is your company's current state? How much cash do you have? So when you're starting out, you may not have all of these, I'll say all of these, like the current assets, like that's cash. Cash would be in banks, accounts receivables, how much, sometimes when you bill people like with the school system or the city, you bill them, you provide the shirts and you give them the invoice and they pay you in 30 days. So that's what your accounts receivables will be. And then inventory, if you buy your own shirts and have somebody do the print press, you bought the shirts. And so you have extra shirts for people that may just come in and want like 5 shirts or maybe 2 shirts that you can do. Supplies, you have that's $250. And then there's no prepaid expenses right now. And then your total current assets would be $9,750. The question in the chat, at what point do you get business insurance, and are all businesses required to have insurance? So all businesses are not required to have insurance, but it's a good thing to have insurance because if something happens, for the t-shirt business, most people do not have insurance unless they have a storefront. And the storefront would make them have like rental insurance, and they may have some type of general liability because that's what the rental agreement says. Most people that I know that do, they start out, they do not have insurance unless it's like construction or some type of professional accounting, CPA or legal firm. I would say that the decision is up to you, but if you have an employee, like if you have somebody working for you, you probably should get workers' comp. And workers' comp just says if they get hurt on the job, for the state of Texas, they usually handle the workers' comp claims. Their income gets paid by the insurance, and you don't have to worry about it. And so once you get an employee, you need to have insurance. If you bought the truck or the car in the company's name, you need to have auto insurance in the company's name. And then once you get a storefront, now if you are a caterer, I would say you need insurance just in case someone becomes sick from your products. You need some type of insurance for that. But you can call around and see how much insurance costs, because since you are not making a lot of money, the insurance should not be that much. Notary business, do you need? No, because you're a professional business. The professional businesses like notary, accounting, legal, really needs E&O. Now, once you have an employee, but I don't know if you would have an employee for a notary business, but just in case you did, probably some type of workers' comp. But you can talk that over with your insurance agent because they can tell you if you really need that. The insurance agents will really know what you need. So let's see. Going down to fixed assets, it is if you owned a building or any type of land, and then equipment for this example is $10,500. That's your printing press. And then, you have accumulated depreciation, sorry, and then total fixed assets of $9,500. So your total assets with the current assets and then the fixed assets would be $19,250. Since you are a cash business mainly, you may have a credit card that you have, and the current portion of long-term debt just means the 12 months. Like in 12 months, what's the credit card payment? For accounts payable, you may have, let's say you have like a gas card, that's $250. So that would go there. And then income taxes payable, we're going to say no, that you pay your income taxes at the end of the year and you don't have anything payable. And so your current total current liabilities are $1,450. Notes payable would just be the rest of that credit card that you have. And then your total liabilities would be $6,450. Now, the thing is the liabilities plus members' equity has to equal total assets. So if your total assets are $19,250 and then your total liabilities are $6,450, your members' equity, you, the owner, would be $12,800. That's how much you have invested into the business. And so the next slide talks about the different things when you go for a loan or if you're getting a credit card, what they look for on your balance sheet and what they look for on your profit and loss. So the first one's current assets. We already went over. That's basically on your balance sheet, and it's just the cash equivalents, like your accounts receivables, inventory, marketable securities. If you had any of those are basically for larger corporations. Prepaid expenses. Sometimes you pay your insurance for the whole year, maybe in January, and you have not, as the year progresses, it pays for itself. But right now, that's a prepaid expense that you have, and that is an asset. And other liquid assets. And so what that means is anything that will not take like 30 days to close on or to sell. And it's easily converted to cash. Your current liabilities, any of the company's debts or obligations that are due within 1 year. So that's when we were talking about the credit card, like what are your credit card payments for 1 year? That's why it fell under current liabilities. And then anything else that would be on the balance sheet, like accounts payables, we would hope that people would pay you within like 2 weeks to 30 days. But usually with small businesses, people pay around 30 to 45, 60 days. And sometimes people will extend that to 120 and beyond. So you have to be real diligent about collecting your money. Sometimes small businesses and large companies, they get into going out to do business development and getting the next contract. And they don't have anyone in the office to say, hey, this company owes you $40,000. I had a client that did that. They kept saying they were an alarm company, and they kept saying, I don't have any money. And we're like, why don't you have any money? Because we're looking at the contracts they have. We're looking at their client list. And then, why don't they have any money? Well, they worked for the city of Dallas, and city of Dallas owed them. They were like 120 days behind. So they basically owed them $120,000 because they were billing them like at $30,000 per month. And they had not realized that the city was so far behind because the city would pay them like $10,000 at a time or $15,000. And that's another thing that you have to be wary about when people, they don't pay the whole invoice. You'll send an invoice for, let's say, $5,000 and they'll pay you $2,000. Well, they still owe that, but they're not paying the whole invoice and you've moved on to the next thing. Current ratios. So when you are doing when you're trying to obtain a loan, they look at this ratio and two more that we're about to talk about. And so it measures, the current ratio is basically current assets divided by current liabilities. And it just measures how well you can pay back your obligations. And it gauges the company to the industry standards. So although you have your own t-shirt company or like your own coffee shop, there's a standard of how much you should make in sales per square footage. There's a standard of how much you should carry in liabilities. And you can get that from the Minority Business Development Agency. They're here in Dallas. They have like those ratios that you can get. Or you can just Google that, and it may be on the SBA website or I think it's on the Small Business Administration website. So that would be sba.gov, www.sba.gov. And so the current ratio equals current assets minus current liabilities. And then the quick ratio, it gauges the company's liquidity. And so it just compares like your cash, market securities, accounts receivables, basically your current assets minus inventory, because sometimes inventory can be hard to unload in let's say a month. So they take that out. If you don't have inventory, it doesn't matter. So that's just a zero. So current assets minus inventory divided by current liabilities. And then this is the big one, your debt equity ratio. Your debt equity ratio, it just shows, how much debt a company is using to finance its assets relative to the amount of value represented into shareholders' equity. Basically, it's trying to see how much money you owe. And if your debt equity ratio is high, that's a problem. And we'll get to that in the next example. The first one is current assets. And so here we have your current assets are $9,750. Your current liabilities are $1,450. So then you take the 9,750 divided by the 1,450 and get a 6.72. Now, for this example, that's pretty high and that's good. Anything over 2 is pretty good for your current assets to current liabilities, because it shows how much money you have in the bank. So usually businesses are anywhere between 1.5 to 3. But since this is a cash business and you have like really no upfront costs other than the inventory, then you should this is just pretty high. So, and it's good. It's a good thing that it's high. That's a high number. The next one would be the quick ratio. And again, that's the current assets minus inventory divided by current liabilities. And so the current assets, the $9,750 minus the inventory is $1,000 $1,000 of inventory divided by total current assets would be $1,450. So your quick ratio would be 6.03. And that's pretty good because that's a high asset test to say, hey, if you needed to sell everything quickly, you could, because you do have a lot of money in the bank with the cash, your accounts receivables, you can sell that off if you need to. But we know that the accounts receivables that you have in your company, the school district will probably pay within pretty much 30 to 45 days. So are there any questions about the different ratios that the banks use? And then the last one is the debt equity ratio. And this is how much debt you have. So debt equity is total liabilities divided by stockholders' equity. So your stockholders' equity is how much you own into the business. And we said that was $12,800. And total liabilities That's all of like your loans. That's all of your if you had a truck payment, that would be in there. Any type of accounts payables, income taxes, and all your loans, whether credit cards or just bank loans. So that's for this purpose is $6,450 divided by 12,800, and you get 0.50. And so that tells you that it's a low risk. So the lower the number for the debt equity ratio, the better. Now with the other ones, you needed like a 2, a 3, a 4 to show that you were profitable and that you had liquidity in the business. But for the debt equity, it needs to be a low number. So higher the number, increase the risk. And that's one of the ratios that the banks look at and credit card companies look at as well. Any questions about financial statements? I know it's pretty hard to grasp everything online. This class is usually taught in person, so people have like a lot of questions, especially when we went over the job cost breakdown. And we can talk about that in the Zoom after the breakout session. We can discuss that. The next one, we're going to talk about the loan programs. The loan programs are for small businesses or even large businesses that are in the Dallas-Fort Worth area. So if you have a bank account, a personal bank account at any type of federal credit union, any type of credit union, or any type of bank, look into their small business loans. Sometimes their rates may be better, but a lot of times their interest rates are higher, and then their business accounts cost more. So these are some of the loan programs that I've used for different clients and that I've heard other people have. And the first one is the People Fund. And so the People Fund's mission is to create economic opportunity, financial stability for underserved people by providing access to capital, education, and resources to build healthy small businesses. And here's the website for the People Fund. Some of the loans that they have, the first one is the Small Business Administration 504 loans. And so it's designed for procurement of long-term assets such as land, buildings, equipment with a useful life expectancy of at least 10 years. So let's say you want to start a restaurant and you have a place in mind. It's a someone selling their business. It's a restaurant already, so it already has all the kitchen equipment, like the stove, the vent, the refrigerator, the industrial refrigerator. It has the necessary restrooms for the occupancy that you want. It has the table and chairs. So you would go try to get a 504 loan. And so when it says SBA, the SBA, banks like to use the SBA loans because it guarantees anywhere between 75 to 85% of the loan. And so sometimes it may be lower, but usually it's up to 85% of the loan. And that's why they like to use the SBA guarantee on the loans. So if anything happens, if you default on the loan, the SBA will come in and pay back at least 85%. And that's why they ask you what type of collateral you have. And they may require, 20% collateral or 15% collateral, because that is what the SBA is going to guarantee up to 80%, up to 85%. So that's one of the backstories of why they ask you to provide collateral up to a certain percent. The SBA microloan is for startup businesses, and the microloan can be up to $50,000 to help entrepreneurs in business for less than 2 years. That one also is SBA guaranteed, and that one right there has technical assistance, which means there are some classes that you probably have to take. You will have a counselor that you have to check in with, and they have other requirements. Probably they're going to look at your financials. They want to see your financials on a quarterly basis, or if things are going bad, you may have to talk to them every week about what's going on. And they may do site visits. So the microloan is just there to help small businesses. Also, when you go talk to people about a loan, make sure you know how much you want. If you say, "Oh, I need about 50,000," then they're not going to take you seriously. But if you say, "I need $50,000 to buy equipment. I need $50,000 for payroll," and you have it broken down, by year or even by 6 months, because you may use the $50,000 in 6 months to fund something, so you can start your increase your growth in your business. And then the flash funds, I've never had a client receive a flash fund just because we haven't applied for one. This is it's a new concept to me, but it goes up to $25,000, so you can boost your business. And it has a low interest rate and fees, and you don't have to worry about a price for speed, because sometimes people charge you to increase the speed on a loan, but not the people fund. So usually the interest rate on the loan is whatever prime is plus 2 to 2.5%. So if prime rate lending rate is at 4% right now, or 6%, let's say it's 6%, then it's prime plus 2%, and it's 8%. But it fluctuates every week. So you just have to talk to your loan agent, your loan officer, and figure out what your prime plus 2 or plus 1.5 or plus 3 will be. And it also kind of depends on your credit too. So if you have some charge-offs or some medical bills, just be upfront with them. Get on the payment plan for those. As long as you're paying, you should be good. If you have any taxes, make sure it doesn't go on your credit report. But if you do owe taxes and you have a payment plan or an installment agreement, I think that's what they call it, that's not a problem. Just as long as you're paying people, then they know that they will get their money back. The next one is the Southern Dallas Development Center or Corporation. This is the one that we usually do our loans through, or our lines of credit for our clients. And they are a bunch of old bankers that just decided to help people out with some grant money or some money from banks to pull together to help small businesses out. And basically, it's just the SDC, they help people with loans for, you may be working on a project that you need to pay people, and it has a beginning time and an end time. And so they help you with that for like a year, maybe 6 months, if so. But maybe 2 years. They will help you through that process and help you pay back the loan or the line of credit. And then if you need another one, then you already have history into the system, and they already know your habits. So they're more likely to help you. Another loan program is the LIFT Fund, and it supports thousands of small businesses. The LIFT Fund, I believe, used to be called Axion Texas. And so they're all over the state of Texas. And I think they may have some offices like in Louisiana or New Mexico too. And so they're there to help small businesses with loans up to $500,000 if you have been in business for a certain time. And then for a startup business, up to $50,000. SBA 7A Community Advantage, and then it goes back to the SBA 504 loans, and then any type of business and financial training. So these programs are to help small businesses. And when you sign up and you apply for these, you're also signing up for people to help you through the process. So you won't be there by yourself. Because sometimes when you're in a new territory, you have a cash infusion, and people may say, "Oh, just go buy a truck." Well, that's not what you said what the loan was going to be for. So you have to use the loan for the proceeds. If that makes sense. Hopefully it does. And sometimes they will, let's say you want to use it for payroll. They may have a requirement that you need to send in your payroll costs every week, so they can approve the draw on your loan, or on your line of credit, because in most instances you will not receive the entire 50,000 or 150,000 at one time. So, and also ask them about payment terms, because if it's a loan or a line of credit, they may be able to extend the payment terms where you're not paying the month after you get your first cash infusion from them. It may be after you've been paid 1 or 2 times by the entity. And that could be anywhere, depending on the entity, that could be anywhere from 45 to 60 days from when you got your first infusion. So make sure you talk about, negotiate those terms that you don't have to pay back at the very beginning, like the month after you receive it or a couple weeks after. It's kind of interesting because it's kind of like pay when I get paid. And so make sure you have that discussion with them, because even with your first draw, let's say, even when you get your first paycheck, if you're working for, let's say, the city of DeSoto, you may not have enough funds to pay back the line of credit or start paying on the loan. So what these people do, they make sure that you have enough money, enough cash flow, so you're not hurting yourself. You're not putting yourself in a further behind with this line of credit or loan. Any questions? Let's see. Okay. So the next one, the next slide, it just talks about the different loan documents that are required for loans less than 25,000. So the business plan with 2 years projection. So I would suggest, like, I write business plans, and there are a lot of people who write business plans, but I would suggest that you try to write your own business plan. And so the business plan, it just has sections about what your description of your business is, how you're going to market your business, what the financial statements will look like, your projections, and then any type of employees and expertise that you have in your business. You can do the first part of it and then have someone come in and make it look real pretty for the loan people. You can do that. But if you do not want to write your own business plan, there are people out there that can, but you write your own business plan, or at least start and answer the questions so you know all the details of your business and you're not shocked when someone's asking you a question. Also, with the business plan, the banker or the loan officer may ask you questions that are inside of the business plan to see if you actually read it or if you wrote it. And so they're taking a chance on you. So they want to make sure that you're competent to actually handle these funds that they're about to give you, and you won't make their portfolio look bad. 15% of owner's equity injection for the business. So how much money did you put in? Did you put in, 2%, 3%? And the 15% may be like you bought a machine. It may be you left money in the business, 15% of your first paycheck. It could be anything that you do, but they want to make sure you have some money in the business. If you are doing maybe a restaurant, they may want to see that you put in at least $15,000 in the business. If you're trying to get a $100,000 loan or something, it is something that they want to see that you have skin in the game. Copy of governing documents. We talked about the filing with the Secretary of State, or your assumed name, or your partnership with the county, your DBA. They want to make sure you have all those documents, that you are a real entity and that they're loaning to someone that is doing business correctly. Your tax ID. Last week, we talked about how to get the tax ID or the employer identification number. Same thing. They just call it two different things. A list of collateral. So what type of collateral do you have? If you're going to get a $100,000 loan, what type of collateral do you have? Do you have some of the different alternative fundings that we just talked about. They take personal collateral, which could be jewelry. They take cars. And when I say that, they want it like a picture or in the value. They won't take it and put it like in a physical, like their safe deposit box. They want to know that you have some type of liquidation for them if something goes wrong. So the next one, the last 2 years, tax returns with all the schedules. That's a personal thing for you, the personal financial tax returns. And then, let's see, hold on. Well, also the 2 years for your business, if you've been in business for 2 years. 2 years of business financials, profit and loss and balance sheet. If you have not been in business for 2 years, I would say, what is your opening balance sheet? Like how much money that you invest into the business, i.e. your owner's equity, your member's equity, how much did you invest? So if that is $5,000, that would go into the cash part and the member's equity of your business. So they just want to make sure that you have some type of something invested. Lease agreement, if you are renting a business, a storefront, they want to make sure that the duration of the loan, if the loan is for like 2 years, if your lease ends in 6, they want to see the lease agreement and see if you can renegotiate it to end with the terms of the loan. And then if you are home-based business, it doesn't matter. The detailed breakdown use of funds, that's what we talked about before. If you're going in and asking for $50,000, what exactly are you going to use it for? Do you have an example of how much? Do you have a picture of the equipment and how much it costs at this point in time? Do you have that? And then, how will you pay this back? What is your debt schedule? How long do you think it will take you to pay this back? And what other debts do you have, like credit cards and things like that? And then 3 months of business bank statements. Just trying to see if you are a real business. And then for loans over $25,000, 3-year projections. For less than 25,000, it was 2 years, I believe. And it's just the same type of information, the 15% owner's equity that you're injecting into the business, copy of governing documents, the tax ID or employment identification, list of collateral, 3 years of business financials, and then your last 3 years of tax returns with all schedules, personal and business, year-to-date business financials, lease agreement, detailed breakdown, use of funds, and verification of loan proceeds. And so they're asking for your quotes and your sales orders and purchase agreements here. If you have that for a loan less than $25,000, I would provide that too, because you want them to have confidence in you. Like you want to have fairly clean credit, money that you invest into the business, and then you have the business plan, and then also the purchase agreements, if applicable. But mainly, what does it cost to buy this equipment or to start this business? This is what I need it for. The business debt schedule. And then also they will ask for the form 4506. The 4506 is when you have filed taxes to the government, and the 4506 will ask for transcripts to make sure that you have not made up tax returns for your loan. Because sometimes people make up tax returns for a loan, or like people did for the PPP. And so the transcript just verifies that if you say that you made $100,000, $150,000 in revenue, it just matches up. And so usually they do that for loans that are, this says loans over 25,000. I've seen that for loans or lines of credit that are like 125 to 500,000. So any questions? Um, and then these are the personal documents that they ask for. They will ask for a copy of your driver's license. The borrows information form is just that company's application. Personal financial statement and 3 months of bank statements. And so that is the personal financial statement for you would have your cash in the bank, how much you have in the bank now, and your checking, savings, any CDs you have, IRAs, 401ks, 403bs. And then they will probably want to see if you own your house, how much is it worth? Um, if you have cards, how much are the cards worth? Jewelry, any other type of rental houses. And then that's the asset side. And then like on the liability side, what do you owe in credit card debt? What do you owe in student loans? Um, what else do they ask for? Do you have any debt on the house? And then do you have any debt on the cars? With student loans, unless you're in default, should not prohibit you from getting a loan. Um, so the current assets minus the current liabilities basically equal your net worth. And then it will also ask you how much you make per month. And if you are married or have any type of additional income, just in case if if the loan goes in default, how can you pay the loan back? Do you have enough money uh, from month to month to pay back a $500 note or a $250 note? Do you have extra income to pay that back if anything happens? Or if you're married, does your spouse, can your spouse pay that back? Um, so those are the things that they ask for. And I think that for tonight, that's it. Do you have any questions? We have about 8 minutes before we go to the breakout session. Let's see if we can go back to the job cost breakdown. One thing I forgot to point out on the job cost breakdown is that post COVID, well, we're not really out of COVID, but now since we're opening up, you've noticed that the prices are going up of everything. And so when you do your job cost breakdown, a lot of people now are having to renegotiate contracts, especially like in the construction industry, because the price of lumber has gone up, the price of steel has gone up. And then like even, let's say with a landscaping business, maybe their fuel cost has gone up. So they may have to renegotiate contracts with different residential customers or even corporations. So when you're doing your job cost breakdown, what happens when your costs increase? Are you going to increase your price or are you going to eat that cost? It's totally up to you, but if you should decide what type of net profit you want to make. Like if you want to make 20%, you can make 20%. If you want to make 30%, you can make 30%. But I will say that corporations already know, if already know that whatever they're going to make 20% off of this or 30% off of this. So you have to decide what is your net profit. So if you have to increase your price, then you may just have to increase your price. And that's just one thing to think about when you're doing your job cost breakdown, when you're looking at your different project schedules, or even if you have a like a hair salon and you have product increases, the cost of your products increase. Are you going to pass that on to the customer? Or are you going to eat that? That's just something that you have to think of, when you're in business. So are there any questions? If there are no questions, we can go into the breakout room for those who registered. Next week, we will discuss marketing, sales, and HR. How are you going to market your business? How are you going to sell your business? And different types of employees that you can have in your business. A lot of people want to do contract employees, but the IRS has a strict definition of what a contract employee is. And if that person does not meet that, they are an employee, and there are taxes that must be taken out. So if there are no more questions, then we can go to the breakout room. In the breakout room, I think the link was sent to you during registration. And if not, I think there's someone that you can probably email. But, oh yeah, the breakout room information is in the chat. So if you have any questions, just let us know. Shaniqua and I will be in the breakout room. Thank you.